Well, good morning, everyone, and thank you for joining us for the Antipodes webinar to discuss balancing the core of portfolios with pragmatic value. My name's David Wright, Head of Client Solutions at Pinnacle, and we're fortunate today to have Jacob Mitchell, Founder, CIO, and Lead Portfolio Manager of the Global Strategies at Antipodes, to present today. Before handing over to Jacob, the format of today is that the webinar will run for about 30 minutes. We'll try and keep that relatively tight. We know you're all busy. Jacob will present for around 15 minutes of that. We'll take questions, so please post any questions you have in the Q&A chat that should be visible on the right hand of your screen. And CPD will be provided for all attendees post the webinar. Just before jumping into it, a reminder that Antipodes really does have the full suite of global equities funds, including the Global Fund, which is the long-short strategy, the Global Value Fund, which is long only and also in an ETF form, Global SMIDs or Global Small and Mid-Cap Fund, also in unlisted and an ETF format, and emerging markets. So it's a very versatile range of funds applicable, to different client types, needs, and portfolio types. Now, Jacob joins us fresh from Antipodes, being freshly minted and awarded the Morningstar Fund Manager of the Year just last week, and also the team is experiencing a great period of fund performance, both over the short term, medium and longer term, which we think really is a strong validation of the experience and commitment of the investment team in remaining true to label, particularly through that period, which is really very difficult for any style other than kind of strong growth style. So that's a real validation of the process and experience of the team. So with that, I'll hand over to you, Jacob, and welcome and congratulations again on the award.
Yeah, no, great. Thanks, David, and welcome everyone today. Really, I just want to go through just a very quick, very brief sort of business update, and then get into how we're seeing markets and positioning portfolios. And it's great to be acknowledged by Morningstar in terms of awards. But as an investment team, our real focus is in keeping the consistency of our results, in line. And I think Morningstar have really acknowledged, I think, just good consistency across the 5 investment teams at the group level, and I'm obviously, I have the role of as CIO of leading only one of those teams, which is the global equities team. That keeps me busy. The other 5 teams report into Antipodes Group CEO, Andrew Finlay. I think the benefits of the group structure you can see there, very importantly in that layer above Pinnacle, between the investment teams. I'll call out, for example, just the investment or the resourcing we now have in operations and tech development supporting all 5 investment teams. That's going to be, in a longer term sense, a critical, differentiator, a critical competitive advantage as we all, lean more heavily on technology within the fundamental framework of picking stocks. Antipodes Global Equities, of our group AUM of just over 20 billion, roughly half of that is in global equities, and we have our team of around 30, just over 30, majority here in Sydney, but we also have a London and a Melbourne office. Pragmatic value is our philosophy. It's really all about paying the right multiple relative to growth and business resilience. So we're very happy to invest across the spectrum of growth and resilience. It's all about paying that right multiple relative to those characteristics. And as David touched on, we have the full suite of product offerings in terms of solving for clients who are in the accumulation phase with the Global Value Fund, also on the ASX's AGX1 Global Small and Mid Cap Fund, also on ASX as mids, and then the Long Short Global Fund, which is solving really for that pension phase investor. I think, just to dwell on the pension phase, obviously there's a significant amount of industry capital that is in that phase. When you have these very long duration bull markets that end up more and more concentrated, as you can see here on this slide, and as bull markets tend to mature, the risks in building up, there tends to be a build-up of macro or tail risk beneath the surface, and valuations are becoming more stretched. We certainly believe long-short variable beta has an important role to play in client portfolios. It's really, it's solving for that investor who cannot, really cannot where the opportunity cost of a major drawdown, not the shallow ones that we've experienced in the past 10 years, but more akin to the ones that we saw in the early 2000s with the unwind of the tech bubble or the global financial crisis. It's really, trying to protect capital, in that for that client who is late in their savings journey, and the opportunity cost of suffering such a drawdown is just too high. Look, when we look at that benchmark of the MSCI All Countries World Index, concentration is roughly twice the long-term trend if you measure it as at the top, those top 10 companies. The benchmark is also very exposed or very weighted into the US, the quality factor, the momentum factor, mega cap, AI enablers. And that is what it is. But all we would sort of advise is that if we're measuring risk relative to benchmark, and we often see with clients almost a singular focus or on tracking error as a measure of risk. And whilst we know that has a role to play, we also think investors should think about good old-fashioned value at risk in the benchmark, and that's very high given concentration. So when we're measuring risk relative to benchmark, let's just be aware of how much risk actually sits in the benchmark, either because of valuations or because of concentration. The other way to think about that risk is, how are those big exposures priced? And the somewhat inconvenient truth is that the big weights, like the US, let's call it the factors like quality and growth, which dominate the benchmark, those style factors, they are above their longer term trend valuations. And those parts of the benchmark that are quite small, like Europe, like emerging markets, like the value factor, on our definition, if you think about the bottom 20% of multiples, we call that the cheap end of value, the bottom quintile of value. You can see there on the far right, it's below its long-term trend valuation, and those companies only represent roughly 10% of the market cap today. So valuation dispersion is very high, and relative to what investors are paying for growth exposure or quality exposure. So what we're also sort of noting is that there still seems to be a perception that, given the headlines that AI is grabbing, that you would think the market itself in the last 12 months has really been powered by this ongoing investment, aggressive investment cycle that we're seeing in the AI space. Look, it's definitely happening, but beneath the surface, you are seeing a real change in leadership, a real broadening out in markets, at least at the regional level. So it may surprise investors that Europe's done a lot better, emerging markets have done a lot better than the S&P 500 over the past 12 months or 13 months to the end of January. So that's interesting. There's been a little bit of a rotation in the style factors. Value's done a little bit better than quality and growth, but that's not really the main story. Has been a broadening out at the regional level. Now, we do think markets are set up to continue to to broaden out. We think for three reasons. The first one is simply that we need to see a real catch-up investment cycle in the West around infrastructure, onshoring, defense, energy transition. The West has very much lagged the emerging markets, especially lagging China on investment. And so this sort of rebalancing of the Western economy away from consumption to investment is going to be quite a rocky journey. And you can imagine what that does to the winners and losers in the stock market, where the stock market is definitely overexposed to consumption relative to investment in Western markets, especially in the US. Within AI, we're certainly looking at that a really rapid investment cycle. Even recently, when all the major cloud companies reported their capex growth for this year came in roughly double what the market was expecting. So there's no slowdown there. But we also think, whilst at the moment the benefits of that are being mapped generally to the semiconductor stocks, we do think there will be, as AI adoption spreads, there'll be a lot of inefficiency in the market as the market tries to discount who are the winners and the losers from adoption. And I think that's going to throw up a lot of opportunities for active managers, for stock pickers like ourselves. And then finally, on the fiscal front, we are seeing obviously Europe, led by Germany, starting to loosen fiscal policy at a time when the US arguably has already had 12 years of pretty loose fiscal policy. So we do think there can be, opportunities that's going to deliver investors who can tap into some of the benefits of that fiscal stimulus that we see coming in Europe, in particular, but also across the emerging markets, where there's been a lot more fiscal discipline, relative to the US. Look, thinking about the type of returns and the fact that benchmarks have been so concentrated, and we're showing on the left how much of the benchmark return in the last 3 years came from different market caps, with almost 50% coming from the mega caps. By region, once again, with almost 2/3 of the return coming from the US. And then by sector, where you see the darker blue, lighter blue, is essentially tech, software and internet. So hardware, software and internet. So roughly 50% of returns coming from technology. A lot of concentration relative to our global value fund returns, where we've beaten that benchmark, but we've done it in a very diversified manner, diversified by market cap, by region, and by sector. And we think that's going to be a very important factor in terms of delivering returns in a very risk-aware way relative to a benchmark that is quite concentrated, where returns have been very concentrated. I'm not going to spend much time here. It's the same message, but it's looking at the 15 biggest contributors to the benchmark return versus at Antipodes, our 15 biggest stocks. Once again, a lot more of a rainbow color on the Antipodes side, much more diversified. So in a 10-year environment, or just let's call it 10.5 years from our inception date, Antipodes, in our long only and long short funds, we've been, we're slightly ahead of ACWI, but we're very nicely ahead of, let's call it ACWI value, but ahead of ACWI, and our leadership on ACWI has grown over time. We've certainly been aware of we have had an allocation drag from being underweight the US, but we've been able to offset that with, I think, excellent stock picking within each of the sector teams. And it's that industry-led approach that helps us find those diversified sources of alpha. Pleasingly, though, if we think about our return per unit of risk, so we're measuring risk here in terms of the volatility of our returns relative to the volatility of the benchmark, and that's that expression of risk-adjusted returns is known as the Sharpe ratio. How much return are we getting per unit of risk relative to the benchmark? And pleasingly, once again, you can see over time periods, we're really building a very good lead. Our Sharpe ratios relative to the benchmark in both the long only and the long short fund are getting further ahead of the benchmark Sharpe ratios, which I think is excellent. I mean, it does prove, I think, that a pragmatic value approach doesn't need to be, you don't have to take on a significant amount of risk or volatility as a pragmatic value investor. And in fact, you can deliver, relatively, volatility, a return profile that is less volatile than the benchmark, and produce very good risk-adjusted returns and returns that also have a lot of downside protection, which we're showing on this chart. I would just call out here very quickly that what you're seeing in the 3-year number in the value fund is what we're getting 88% of the benchmark return and only exposing our investors to 28% of the downside. Now, when you look at the same number on the long short fund, now the way you read this is we're getting 67% of the upside, but in fact, you're not getting any downside. In down markets, you're actually getting upside. That's the positive 42%. So just amazing asymmetry in the long short fund and also, between and long only fund between upside capture and downside protection. So that's been a result, I think, of enhancing our approach to risk management over our 10 and a bit year journey. And what I'm going to show what I'm just going to sort of unpack very quickly is a few stocks that really demonstrate our different ways of deploying our industry knowledge. The first idea is SLB, which is the leading oil service company in the world. It's certainly been exposed to a sector that's gone through a very long down cycle, and that's where we think the market is being inefficient in pricing a recovery. As the shale patch in the US has matured, the major oil companies are now having to shift back to exploring offshore, deep water exploration. And SLB is very well positioned for that switch in capital spending focus away from shale to a more broader spend. And we're paying less than a market multiple for a business that is at the beginning of a cyclical upswing in its earnings, with a really strong balance sheet. Even today, they're returning roughly 10% of market cap via buybacks and dividends. I think within the mega caps, Antipodes has demonstrated the really high conviction around which of the mega caps has been interesting at any point in time. We almost roughly 9 months ago, we took a relatively large position in Alphabet when the stock was on 16 times, when investors were really concerned around the disruption risk that Alphabet was exposed to. We think today that the most interesting opportunity in the mega caps today is Amazon, because it is seeing this acceleration in the AWS business, in that business that supplies compute via the cloud to corporates. As corporates large language models need more compute. And certainly it's, I think, a beneficiary of AI adoption. And it's sort of the cheapest multiple that it's effectively ever traded on. For a company that's growing at roughly 20% per annum, we think 25 times is very cheap. You consider Walmart, which is on in the high 30s type multiple, high 30s, yes, that's right, and it's growing at about 6%. We think that's it's quite interesting how derated Amazon has become, and it's a great way to participate, I think, in a structural trend which is mispriced. And then finally, socio-macroeconomic opportunities. There's nothing more predictable than aging, unfortunately, and we're really, we're looking at the grey tsunami, the baby boomers today. The first of the baby boomers are turning 80. And we expect between now and the end of this decade, the demand for aged care in the US is going to double. And at the moment, rents don't even reflect the replacement cost of aged care. So we see a significant pricing cycle that is emerging in a company like Brookdale that's trading on a EV, enterprise value to EBITDA multiple of about 10 times. Versus the industry leader, Welltower, which is on roughly 3x the multiple. So in the long only global value fund, you can see here across the portfolio, our weightings between these more cyclical opportunities versus the more structural opportunities, and then the ballast of the portfolio, cheaper defensive exposures. Regionally, yes, we do remain underweight North America, but it's been really driven by in Europe, the opportunities we still see in multinationals, as well as developed Asia, which tend to be on a like-for-like basis, still cheaper than a lot of their American cousins. And then in the emerging markets, it's more domestic-facing businesses. It's the one region in the world where you can buy quality at a relatively low multiple, in an environment where that factor still remains very expensive. So similar tilts that you can see in the long-short fund, obviously with lower nets as a result of the shorting, and then just very quickly, the way we've evolved the shorting approach, which I think is showing up in better, even better, let's call it capture ratios in long-short, around the use of our three different buckets: the single stock shorts, our basket hedges, and tail risk hedges. So really what I want you to take away today is that value as a factor is relatively cheap in the market. B, allocators, client portfolios tend to be very overweight, very exposed to the benchmark, either via passive or via core. And I think a pragmatic value approach, a very risk-aware approach to value management is an excellent diversifier for core portfolios, with a tilt that actually still remains quite cheap and arguably timely. And obviously from a pragmatic value perspective, we're really looking to add value to that factor exposure. And, I think we've demonstrated an ability to do that over our period of from the inception of the firm. So I'll hand over back to David for some Q&A.
Thanks very much, Jacob, for those non-standard insights. It was refreshing, to be honest, and also insights into the types of companies that you and the team are investing in and the positioning of the portfolio. But we do have a couple of questions with regards to performance, which I'll ask you separately, but the following two tables probably go some way to answering that. So the first is really the peer comparison of the funds, both in the global value universe, which is much larger, as opposed to the global fund being the long short, where the universe is smaller. Now, one of the things we wanted to point out here is this is not just a sort of short-term, bounce in performance. You can see that over the long term, the Antipodes global Value Fund has performed, very favourably, both against that peer set, which includes a number of the value competitors, as well as against the benchmark, the MSCI All Countries World Index. And similarly with the Global Fund, the long short, and as Jacob mentioned, with that comes some downside protection and also ability to generate returns from the shorting side of the book. And actually, we've got a question with regards to shorting as well in a moment, Jacob. And then the following is really in relation to the global SMIDs. Now, this is a universe that has grown a lot in the last kind of probably 8 or so years. Most of the peer set we've included here is the domestic or the Australian-based global small or mid global SMIDs universe. There is a lot more than that now. It's become a pretty busy space with a number of the global players coming into and offering product in global smalls and SMIDs as well. You can see probably 2 takeaways here. One, the Antipodes global SMID's been around, one of the longest. And 2, it's not just a short-term phenomena in terms of both peer comparison and against that of the MSCI ACWI SMID index in this case. So I might jump to a couple of the return-related questions, Jacob. And the first one's a good question, pretty short, but is the recent strong performance just a result of, a rotation to the value factor?
Yeah, it's a good question. So as I pointed out, we really haven't seen that. I think you sort of have a free option on that happening, but it really has just been driven a little bit in terms of our results. It's been driven by some regional broadening out, where that allocation drag of being underweight the US has turned into a tailwind rather than a headwind. And really good stock picking. I'm really proud of the team, and just in terms of the persistence of the selection alpha that the team's been delivering, and obviously I think in long short, we've improved our upside capture, but it hasn't come at the sacrifice of downside protection. Yeah.
We've got another one. It's a nice segue actually, Jacob, into and I love the chart, and we found advisors and clients love the chart that shows the diversification of the portfolio as against the concentration of the benchmark in that sort of color-coded chart. But the question is, the more diversified and active way you invest, and the broadening out of stock returns has produced, good returns more recently. Has that run its course now, or do you think that's kind of a sustainable and longer term thematic?
Look, I think you're at the beginning of a really interesting period for active management, simply because that benchmark, the starting position is a benchmark that's really quite crowded and concentrated, number one. And number two, AI is very disruptive, and it really is going to reshuffle the deck in terms of winners and losers, and we see that happening on a daily basis. And we think the markets will go through a period of significant inefficiency as those winners and losers get priced in, and certainly that's, I think, throwing up opportunities.
A good question here in relation to shorting. I think this is a really good observation, so thanks for the question. But shorting went through a very difficult period there for a while, with poor quality stocks rallying and often them being the shorted stocks, and it was evidenced by challenging returns for a lot of long short, both Aussie and global for that matter, and market neutral funds. But shorting seems to have come back with a vengeance. Why is that, and do you expect that to continue?
Yeah, look, I'd love to say shorting is easy, but it's never easy. Maybe the environment's a little bit more conducive to getting to finding shorts because of the this inefficiency that's evolving in the market around AI adoption. However, I think our overall process has also evolved, and I think that is sustainable. That's absolutely, evolution that we think is, led to a permanent improvement in our process, which is, as I show on the slide, we sort of really started out using quant as a screening tool, and then in that period, in the middle period, we really deepened our risk model approach to thinking about aggregate portfolio risk and the ability to run, let's call it optimization and also scenario analysis on the portfolio in terms of how it would behave in certain environments. Certainly, I think that's helped us in terms of aggregate portfolio risk across all portfolios, but also tools to manage the net, combination of measuring positioning in markets, changes in the volatility profile of markets as a way of tactically managing the net. And then more recently, and you can see it in the short book, the development of using quant not just to manage risk, but to identify alpha opportunities and build. Roughly a third of our short book now is coming from basket type shorts. So we have a third from single stock shorts, a third from more systematic quant basket shorts, and then a third is our, let's call it net management, tail risk hedging.
Good answer. We're bumping up against time, but we've got a couple of questions here. I mean, no equities webinar would be complete, Jacob, without an AI question. So we've got one here. You spoke about AI shifting from enablers to adopters. What types, and you did touch on this actually, but what types of sectors and companies are the likely beneficiaries?
Look, there's probably, let's go with the losers. I mean, the market's pricing in obviously a significant headwind for companies that are exposed to human services. So where the human IP may be replaced by, by AI, and that will be very deflationary for their businesses, and where they don't have a great market position or a customer lock. Look, but at the moment, the market's been pretty broad in applying that framework, and arguably it's probably applying it to certain areas where that isn't likely to happen. I think in the software space, the market's been pretty indiscriminate in the way it's discounted software as being, all software is being disrupted. We think there will be software companies that have really good customer lock. Companies like a Salesforce or a Workday. And it will be very hard to replace them in the corporate IT stack. And those sorts of opportunities are becoming more interesting to us. Also, businesses that are internet verticals where a company like Amazon, in the most bearish scenario, investors are worried that somehow that business can be abstracted. But where I think you have protection is in any company that's actually in the physical world. Even if it is an internet business like an Amazon, it has physical warehouses. It's going to be very hard to disrupt, and that's probably the other angle where the market's putting a big premium on so-called hard assets. And obviously we get exposure to that in companies like Brookdale, hard assets as in aged care facilities. No, completely AI agnostic to my knowledge anyway. I can't see what the AI risk is in that business. And we expect those sorts of businesses to ultimately trade on pretty premium multiples in this phase of discovery where the market is ultimately it's trying to find its way to efficiency. But that will throw up lots of interesting opportunities, I think.
Conscious of everyone stayed with us, so thank you for that. One final question, which is an important one. What are the kind of left field or tail risk that you're concerned about going forward?
Yeah, sure. And look, I should say, just on that last question, one other area I think I should touch on is healthcare, because I do think healthcare, with the way these large language models are advancing intelligence, we do think there will be an explosion of new drug discovery. And I think that's another ways to finding the right play on that is going to be interesting. But if we can sort of find those right exposures to that, I think that's another major shift that's going to take place. Look, from a tail risk, I think we're seeing a real negative feedback loop at the moment between the software valuation sector, the derating that's happening in listed software that tends to be very cash-rich balance sheets, impacting private equity valuations and also private credit exposure, because there was a large cycle in the US of private credit moving into asset-like exposures at relatively high multiples with a lot of leverage, and now clearly, that is starting to see, we're starting to see concerns around the write down of the equity and potentially also of the credit, and that's a significant risk, and I don't think it's going away. And ultimately, we also worry a little bit about, well, if the hyperscalers are continuing to invest aggressively in AI adoption and corporates go down that path, will we see unemployment occur before we get the benefits, the real productivity growth benefits, and how do governments respond to that? So we certainly do believe that our framework is, for watching employment very closely, because employment markets are finely balanced. If there's any fall off in job demand, it will certainly flow into unemployment pretty quickly. And so thinking of ways we can create downside protection across all the portfolios is certainly front and center of mind at the moment.
Great. We'll close at that point, Jacob. Thanks very much for those insights and update on portfolio positioning and going forward. That's been really insightful. Thanks everybody for staying with us for the duration. As I mentioned, CPD will be sent out post the event. And if you would like any further information, please contact your Pinnacle BDM. There is a couple of questions that we haven't got to. We will address those to you directly. So thank you again for your time and attending.
Yeah, thanks everyone, and thanks David.